Welcome to a demonstration of the CML Viz Trade Machine Pro custom strategy features. We're going to look at two custom strategies and how they can affect option trading. First, we'll start looking at SPY, which is the ETF that replicates the S&P 500. If we simply bought an at-the-money call over the last 3 years, trading the 30-day options, we would have returned 51.8%. And we can see how that strategy has done relative to the index itself. The gray line is the index, the blue line is the option strategy. But let's try a custom strategy. We'll click Custom under Strategies, and we'll click Add. This is going to be a rolling call calendar. Here's the idea. We're going to buy a call at the money every 30 days. But we're going to offset that long call by selling a weekly call that's out of the money every 7 days. We come down here and we want to uncheck close all legs with front options. In other words, we want to buy this monthly option and for 4 weeks sell this out of the money option and see how it affects our returns. We'll hit save, and here are the results. We went from a 52% return to a 97% return. We can see our win rate has jumped to almost 70%. And we can come down here in the chart and see the blue line is the option strategy and the gray line is the index, and we're vastly outperforming the index. In fact, we can just click on the tile and see that the back test returned 97%, while the index was up 33%. But let's see what's actually happening. We can download all of our trade data into Excel, and I'm going to select just 1 month to show an example. And here we go. We can see on March 18th, we bought the 30-day call for $2.41. At the same time, we sold the weekly call at 46 cents. So our total strategy cost is $1.95. On March 24th, our weekly calls expired worthless. Then we went ahead and opened another short weekly call, expiring on March 31st, and we sold it at 15 cents. When March 31st came around, those calls were also out of the money, and we collected all 15 cents. Then we went ahead and sold another weekly call, expiring on April 8th at 50 cents. When April 8th came along, those calls were also out of the money, so we collected another 50 cents. Finally, on April 15th, which was the day of expiration of our monthly options, we closed those monthly options at $2.78, remembering that we purchased them for $2.41, so we made a 37-cent gain. But our profit from the strategy wasn't just the difference in the price of the 30-day option. It was all the weekly options that we collected as well. In total, we started with a strategy that cost $1.95, kept collecting premium, and sold our 30-day option for a profit, and the return was 76%. Now, had we just bought the call on March 18th and then sold it on April 15th, that's the standard long call strategy, and here it is. That return would have been just the 37-cent gain, which is 15%. So we can see why this strategy could outperform just owning a long call. While we're at it, we can check this against other indices or other stocks simply by putting a comma delimited list. So if we put IWM, that's the Russell 2000, we could look at the NASDAQ 100. And while we're at it, we could look at Apple and even the gold ETF. And here are the results for that list. It turns out that doing it in the NASDAQ 100 was pretty similar to the S&P 500, but doing it in the Russell 2000 or Apple or even in the gold ETF was much worse. Now let's look at a more sophisticated use of our custom settings that makes use of not only a custom strategy, but custom earnings handling. In this case, we'll use Amazon as our example. We want to add a custom strategy. Now what we want to do is we want to buy the at-the-money straddle using the 30-day options. So long call 50 delta 30 days, long a put 50 delta 30 days. And we want to sell the weekly at the money straddle. So we go to short put 50 delta 7 days and short a call 50 delta 7 days. And we'll call this long short straddle. But we don't want to do this all the time. We want to do it with a custom earnings handling. What we want to do now is buy the monthly option at the money straddle 1 week before earnings and close it the day before earnings. We're not interested in taking earnings risk. And we want to sell the weekly at the money straddle, a week before earnings and closing it the day before. So we are buying an at the money straddle with the monthly options and selling an at the money straddle with the weekly options. But we're only doing it for the week before earnings, and we are not letting earnings occur. We're not taking an earnings bet. If we would have done this in Amazon over the last 2 years, the strategy would have worked every time and returned 95%. But remember, this 95% over 7 earnings dates were just 7 weeks of trading. It's 1 week before each earnings. While we're at it, we might as well compare Amazon to the other mega cap techs. So we can put in Apple, Facebook, Netflix, and Google. We just hit enter. And here are the results. We can see Amazon does far better than the other mega cap techs, but Facebook is certainly worth a look, whereas Apple, Netflix, and Google don't work. So this has been a demonstration of the custom strategy builder combined with the custom earnings builder. Our previous example, which was just buying a call and selling an out of the money call every week, was a use of the custom strategy builder, but we did nothing special with earnings. Of course, there are other things you can do. The custom strategy builder allows you to do whatever you want, up to 4 legs. If you're doing calendar spreads and you want both the front month and back month to close at the same time, you would check this box. If you want them to roll independently, like we did in our first example, you would make sure to uncheck this box. You can also add stock to your custom strategy. And remember, you adjust the contract size inside the custom strategy. You don't do it the way we normally do in our general settings tab. Thanks for watching.